Well, hello, everyone. I am thrilled to be here, and I hope you're half as excited as I am. We have such a powerful discussion lined up for you today that I am really thrilled and honored to have the opportunity and privilege of kind of welcoming you to this event and hosting and moderating a panel discussion as the second part of our meeting today. My name is Devin Thorpe, and I am presently serving as the volunteer president of the Crowdfunding Professional Association. And the CfPA, as we most often call it, is an organization designed to help foster the growth of the crowdfunding industry on both from both the standpoint of investors and entrepreneurs. We want to make sure that this space is growing and growing rapidly. That is our fundamental goal. And we invite all of you to join with us, to participate and help us in achieving that goal. We'd love to see, and I suspect our first speaker is going to take us through some data showing great growth, but we're excited to see that. We want to put a kink in that curve and see it grow even faster. So we appreciate you being here today for that. Our first speaker is Woody Neese, Sherwood Neese. He's a principal and chief crowdfunding data analyst for Crowdfund Capital Advisors, a partner at Crowdfund Capital Ventures, and co-founder of Guard. He's an expert at building successful businesses. As a three-time Inc. 500 winner, whose former company won E&Y's Entrepreneur of the Year, Sherwood understands the keys to entrepreneurial success from concept to company to capital to sale. And I would just add, Woody is genuinely one of the OGs of the crowdfunding space. He was there walking the halls with some of the other folks in this world, bringing about the passage of the Jobs Act that created what we now call Regulation CF and Regulation A+. Woody, it's a thrill to have you. We're excited to hear from you this morning.
Let me take it off the mute. It's great to be here. It's also great to be on the panel with Jenny, who, when we got to Washington, we learned about her initiatives. So there were a bunch of us there. She actually showed up before us. We didn't know about it, but collectively, we all working towards the same thing. So, it takes a team to get things done. I do just want to give an overview of what I believe is a massive success. When we went to Washington, D.C., our country was looking for jobs. They were looking for economic stimulus. We had this idea, along with Jenny and many others, that if we can get capital in the hands of entrepreneurs that are innovating, not only can we create these amazing companies, but we can create jobs and economic stimulus in local communities in a way that the government never could. So I built this database after the president signed the bill into law. That went live when the industry launched. And I've been collecting information on all the companies that are doing these offerings on investment crowdfunding platforms since the inception of the industry. And I track this information. I send it over to Bloomberg on a daily basis. So if you have access to Bloomberg Terminal, you can see all this data in there. And we capture about 150 data fields on every single company that's raising money online. And it's just been fascinating to see. I feel like I have a crystal ball in front of me that sort of can tell me what are the future Facebooks and Airbnbs that are going to come out of this space, because I do believe that they're not going to be founded in Silicon Valley, New York, or Boston, but they're going to come out of universities, they're going to come out of cities like Denver, where I live, and they're going to be funded by people that know these entrepreneurs and believe in them and see what they can accomplish. So just to jump into some of the data itself, since the inception, there's been 5,700 companies, these we call them issuers, that have gone out to raise capital online from their friends, family, customers, and followers. They've run 6,600 offerings. So you can see between those two, companies are going back to their friends and family again for follow-on rounds of financing. So this isn't just a one and done thing. This is a on-ramp. This is a way in which these companies can go out and back to their friends and family and raise additional capital. This is a spread capital and spread opportunity across the United States. There has been 1,620 cities funded across the United States. So we were talking about democratizing access to capital. Well, I think you can check that box because we clearly have been able to accomplish that. This is interesting, there's been 1.6 million investors that have invested $1.6 billion. So the average investment's been about $1,000 from each of these investors. So there was a lot of fear, like, well, there's fear that grandma's going to lose all of her money. There was a lot of fear that there's going to be fraud. Well, there's been like one case of fraud since this industry got started. You know, I want to sort of strip that out of the conversation because I think it's very hard to commit fraud within investment crowdfunding. You know, and so when you look at what's been created, you've got companies. These companies are actually building things that are hiring people and hiring products and services. They're spending about $4.8 billion right now. That's $4.8 billion pumped into these local economies. They're worth about $54 billion. So I told you earlier, they've raised about $1.6 billion. The enterprise value based on their most recent valuation is about $54 billion. So what does that mean? Someone's getting rich, okay? You've got all these investors, 1.6 million that have invested in these companies. At some point, there's going to be an exit. I don't care if it's, you know, 1 billion. Take that 1 billion and spread it around those investors that invest in that company. You're going to have a lot of millionaires. The token side of it's been fascinating as well. Of the crypto issuers, we've got 42 that have issued some sort of token. So it could be a token, a convertible note with a token attached to it, a common stock with a token, and that's what I looked at. There were 42 of them. 32 of them have been successful. The majority of these token issuers took place in 2018 and 2019. They've raised about $18 million from 24,000 investors. They pumped about $3 million into these local economies. They're worth about $431 million today, and they've got a 76% success rate. So it's a great area for token issuers to look at how you can raise money. And I'll tell you why it's great. The framework under which you can issue, let's just assume that the Security and the Exchange Commission is going to say that all crypto assets are securities. And they've pretty much come out and said that itself. There's 10,000 of these tokens out there right now. They're going to need to come into compliance with some sort of regulation. So if you want to issue a token, how are you going to do that? Well, you could try to do a Reg A offering, but it might be difficult to get the SEC to qualify that type of token offering. Or you can do regulation crowdfunding because there's no restriction on the type of securities that you can issue. There is a 1 year holding period that these securities need to be held, after which time they can be freely transferable. So when I look at the token issuers, it's been pretty fascinating because they attach tokens to the products that they're developing. So it's not just a token for nothing, it's a token for something. And it's got economic value attached to it. So these tokens can trade after 1 year. And I think if these other token issuers want to be in compliance, they need to look at regulation crowdfunding, I think, as a mechanism under which they can issue a token. You have to do disclosures so investors can be informed about what the company is doing. And then after a 1 year period, these tokens can trade. Now, here's a really interesting thing that I think is an opportunity in the space. If some of these companies that have issued these tokens that are freely transferable realize that their model might not be, one that is where they thought it's going to go, what about some of these crypto tokens that have been issued to date that are looking to come into compliance? Well, what happens if there was a merger between these two companies? Could those tokens then be merged together? And could those securities then be tradable? So there's many ways in which you can look at the crypto space and figure out, and talk about how I can be compliant from the get-go, or how I can look at becoming compliant after the fact. But I think this whole industry and this crypto side of things will be a big part of what we see in online finance. I just really want to wrap up with, we came out with our 7th annual report. It's got a ton of fascinating things in it. We had huge proclamations in there. We claim that the Valley of Death is actually dead. It's been filled by this void, that regulation crowdfunding is a massive success. We've been able to democratize access to capital. Women and minorities are getting up to 50% of the money. Check that one. Show me anywhere else in the industry where that is possible. This is a jobs engine. We're pumping out about 226,000 at a minimum jobs that we're supporting through this initiative. And like I said, we've got average Americans that will become millionaires. So I'm excited for this topic. I know it's controversial, but I think that from my point of view is if we can bring the controversy into into a regulated fashion and do what the regulators want, which is disclosures, then let investors make the decision that they want to make with these crypto assets as they see fit.
Woody, thank you so much for setting the table for us today. This is going to be such an important discussion. We really appreciate you framing it up for us. So thank you very, very much. We're excited to have a couple of great panelists with us today. Our first panelist is Nicholas Weaver, who received a BA in astrophysics and computer science in 1995 and a PhD in computer science in 2003 from UC Berkeley. In 2003, he joined ICSI, first as a postdoc and then as a staff researcher, and joined Berkeley in 2018 as a lecturer in computer science. His primary research focus is on network security, notably worms, botnets, and other internet-scale attacks and network measurement. Other areas have included both hardware acceleration and software parallelization of the network intrusion detection, defenses for DNS resolvers, and tools for detecting ISP-introduced manipulations of a user's network connection. He has also focused on a decade of cryptocurrency with a primary focus on its endemic criminal nature. Now, our second panelist is Jenny Casson, and she has over 25 years of experience as an attorney and advisor for mission-driven enterprises. She has helped her clients raise millions of dollars from values-aligned investors and raised over $2 million for her own businesses. She's the author of Raise Capital on Your Own Terms, How to Fund Your Business Without Selling Your Soul, published by Barrett Kohler. Jenny earned her JD from Yale Law School and a master's degree in city and regional planning from the University of California at Berkeley. She also serves on the CfPA board. We are thrilled to have these two on our panel discussion today. Let me direct a question to you, Jenny, to get things started. Can you tell us about securities regulations and what their purpose is?
Sure. So, and a lot of people don't know a thing about securities regulations. I'm not sure who we have in the audience today. Some people don't even know what they are. Some people are much more familiar with them, but I'll just assume that folks who are listening maybe need a real basic introduction to securities law. So the securities laws were passed in the early 1900s because there were a lot of people going around and offering, get rich quick schemes to regular folks, and sometimes not telling the full information. Maybe the whole thing was fraudulent and a lot of people were losing money. And so some states, Kansas was the first state, and then many more states started passing these laws that are designed to require anyone offering any kind of an investment opportunity to fully disclose all the information that would be relevant to someone making a decision about whether or not to invest. And so in 1933, the federal government passed the Securities Act, which did the same thing that the states were already doing. And it's evolved into a very complicated set of regulations that, but the main purpose of the regulations is to try to make sure that before anyone makes an investment in something with the expectation of making a return on that investment through the efforts of others, not through their own efforts, but they're giving money to someone else and trusting them to do good things with that money to make it grow or to pay out returns, that they have all the information that would be relevant to make an informed decision. And there's also there's an aspect of the law where there's an assumption that if you're less wealthy, that you need more protection. So there's this concept of the accredited investor, which is generally defined as someone who has a certain level of wealth or income. There's a few other ways you can be accredited, but if you are accredited, it's easier to be presented with investment opportunities. And that's why we got so excited when we were able to get the Jobs Act passed, because for the first time at the federal level, it made it possible with a relatively low amount of effort to be able to present investment opportunities to the general public. So, but there's many different ways you can legally raise money from investors, both accredited and unaccredited. Even before the Jobs Act went into effect, I was actually helping my clients do public offerings of securities to, both accredited and unaccredited investors. So it was possible back then, and it's still possible to do it under different laws and, state laws and things like that. So there's many options. But, the idea is you want to understand what all the options are under federal and state securities law and pick the one that makes the most sense for you as a company trying to raise money.
That's a great beginning to this discussion, Jenny. Thank you very much. Nick, I want to go to you now and just ask you kind of a high level question, but one of the key things that people often say about crypto is that it serves as an effective payment channel. Do you see cryptocurrencies as serving as an effective payment mechanism?
No, unless, of course, you're a criminal. That the idea behind the cryptocurrencies is let's build a system with no trusted intermediaries that can censor or block unwanted transactions. But the consequences is all these cryptocurrencies have these volatile prices, bounces up and down all the time. And so what ends up happening is the recipient of the cryptocurrency wants to actually turn it into real money. So you have a currency conversion step. And then on the other side, you've got the getting the currency into the cryptocurrency. And so the net result is it ends up being much more expensive to transact in cryptocurrency than it is to use the digital monies we've had for a generation. And the only way around it is you have some issuer that is basically recapitulating the 18th century banking system, giving tokens and then also being able to redeem them. And so for payments, most systems that have claimed to accept cryptocurrency don't. They actually are using a service that basically allows them to price in dollars, presents the amount in Bitcoin or Ethereum or Dogecoin to the buyer, and then converts it back into real money. So as a payment channel, it's subpar unless you need a payment channel which you don't have a sensor on. And that basically leaves drug dealers and ransomware purveyors.
Yeah, crazy market dynamic. We definitely see a correlation between the use of crypto and practicing criminals. Now, Woody, you mentioned that there were, I think, 42 Reg CF offerings that were conducted that involved a token. How do you distinguish regulated crypto offerings from non-regulated crypto offerings in your mind?
Well, these are exempt offerings, so they're not registered with the SEC. They are following an exemption that allows them to issue these securities, provided that they issue disclosures that the SEC believes investors need to make an informed decision. So essentially what these issuers are doing is they're incorporating their business, they have a business model, and then when they want to go out and they want to raise capital, they're selling securities, which can be, common stock or it can be a token, and that's what the investors are buying. So they're buying the future potential of that company down the road. And in the case of these tokens, one of the things that we know about investing in private companies is historically, when you make an investment, you're sort of stuck there until that company has an exit. So that's an IPO, a sale, or a merger. I think what the tokens provide is the ability for liquidity prior to that exit event. And that's something that is new in the marketplace. It hasn't really been a feature of what's been happening in these offerings because, companies just might not want their securities trading on a secondary marketplace because then you've got, again, this fluctuation in price. And if you're out doing multiple rounds of financing and your security sells below that recent value, well, that's the true value that investors, if you think about it, are willing to pay. So you're going to have to reduce your valuation. So there's pros and cons. I mean, you have to go into it with the eyes wide open. But I think the exciting part of it is for those companies that have the potential for liquidity and do issue these tokens to investors that hold on to them for a 1-year period, this is how we prevent pumping and dumping of these securities. There is the ability for them, if the company's doing well and there's a lot of demand for those tokens, to say, you know what, I want to list my tokens on some exchange and get some liquidity without having to wait. And so, I think there's benefits. This whole crypto thing it's so wide and deep. You have to look at it from very different sides. And, I look at it from the issuance of security perspective, as opposed to the currency side of things. So, take into account that that's how I'm talking about it.
Yeah, thank you. I think that's a really helpful step forward. But Jenny, why don't you take us through a little bit of your view of the regulatory environment here?
Sure. Well, I just wanted to jump in and say that there's nothing inherent about tokens that make them more liquid than any other security, except that maybe just administratively it might be a little bit easier to track transfers. But I don't want anyone to think that somehow a token has more liquidity potential than any other type of security. Any security is equally tradable depending upon like the legal the state and federal securities laws. But yeah, I'm sorry. So what was your question, Devin?
So just maybe you could just further develop this idea, the regulatory framework for offerings that might or might not include crypto, especially those that include crypto. What are the rules?
Yeah. So the first thing that you want to do if you do want to raise money, you want to first determine, is it a security or not? And a lot of the thing that was being played, the video that was being played before we started, there was some discussion of this. A lot of folks have gotten it in their head that for some reason a token or an NFT or a coin is not a security, and they've tried to come up with ways of saying it's not a security when most of the time it is, because the whole reason that people are selling these things is to raise money that they're going to use to grow their company, and then the people who are putting the money in are expecting some kind of a return. So that's number one. And I appreciate what Woody's saying about let's just accept that these are securities and let's go ahead and do things right and act as if they are securities. And so once you do that, it really doesn't matter if it's a stock, if it's a promissory note, if it's a convertible note, if it's a safe, if it's a token, whatever you call it. If people are putting their money into that thing, buying that thing with the expectation of getting some kind of financial return, it's a security, and therefore you need to choose which securities compliance strategy you want to pursue. And there's many, but one really awesome one is regulation crowdfunding, which did become legal in 2016. And you do have to go through a platform. There's quite a few very complicated rules about what you can and can't do. We actually see a lot of things happening on the platforms now that actually are not done correctly or legally, unfortunately. So it's still a bit of a Wild West. But, if you have a lawyer who really understands the rules and what needs to be done, and you're working with a platform that respects the rules and takes them seriously, you can offer anything you want that is a security, as long as you fully disclose, what it is you're offering. You complete all the disclosures that are required under the regulation crowdfunding. So yeah, you can totally offer tokens, any kind of security. But yeah, you might as well just accept it's if the whole reason you're selling it is to raise money, chances are it's going to be a security. So you might as well just accept that.
Yeah, that's a great point. I want to go back to Nick, and I want to stay focused, right, kind of segue from your last point, Jenny, that people, issue securities to raise money. And Nick, back in 2017, I think we saw kind of the peak of the crypto capital raising, although they may not have called it capital, but there was a huge amount of money raised with the issuance of cryptocurrencies in 2017. And a lot of those cryptocurrencies evaporated very quickly, but millions and millions of dollars was raised that way. Do you, looking back now with a little more perspective, do you see crypto as an effective way to raise money?
In general, no, because one of the things that in that bubble is you're talking about stuff that are securities that aren't doing the regulation, that once you go through the paperwork necessary to do a legitimate offering, then it kind of goes, why bother? And in fact, the reason why we've seen so much is a couple of venture capital firms have created what is best described as a gig economy for securities fraud. So Anderson Horowitz or the like invest in a startup that is doing something like privacy preserving machine learning on the blockchain. Yes, that is nonsense word salad. Yes, they invested. Now, when they invest, they also create a huge number of tokens that they then sell on unregulated exchanges like Coinbase or whatever to retail and leave retail holding the bag. And in fact, like one of the things that the SEC flagged as being a blatant security on the recent insider trading at Coinbase case, well, if you actually look at it, one of the big investors was Coinbase Ventures. It coincidentally gets listed as on Coinbase, who insist that nothing they list is a security, so they aren't actually regulated as broker-dealers, sell to a bunch of people, and then this project just literally disappeared in a day a few weeks ago. So there's been a huge amount of money raised, but it's been raised by people who have basically chosen to deliberately ignore the securities laws. And the reason why it's so profitable is the proxy business model of, even if they go after the issuer of the token, and the SEC is finally waking up and doing this, they're going after the issuer, not the venture capitalists who've already made their money.
That's a really helpful context, Nick, and I appreciate you jumping in there. Woody, we've talked a little bit already, kind of hinted, and you brought it up, this idea that there are secondary market potential with tokens, but it's also true of Reg CF shares, right? There is an interesting prohibition in the Jobs Act itself that says that these shares can't trade for a year after they're issued. The implication being that after a year they can. So tell us a little bit about how you see secondary markets developing for Reg CF shares and including tokens, and how those might be different if they're different in any way.
I mean, I think the real opportunity for what's happening in Reg CF from a secondary perspective, Reg A, which are, once they're qualified, the shares can be freely transferable, is the fact that if there is supply and demand, you have a marketplace. Now, what's fascinating is you don't just have the ability to list these tokens if you're doing like a Reg CF and you want to have retail investors trading these on these exchanges, alternative trading systems that are in there. You actually have to provide ongoing disclosures. So it's not like one and done, the company raised money and investors don't have any more information. If these companies want to actually allow investors to have liquidity and list these tokens or these securities on these alternative trading systems, there's a compliance pathway that they have to follow as well. And the easiest way for them to be in compliance is to use what's known as the manual exemption. And the manual exemption states, if you provide ongoing disclosures in what's known as the National Securities Manual, which is like, you can consider it a private type of EDGAR. EDGAR is where public companies file the 10Ks and 10Qs, so investors and analysts and the media can cover what's happening. The National Securities Manual is the private market equivalent of that. So if these private companies publish ongoing disclosures in there, and this is made available to anyone, So regulators have access to it, investors have access to it. The ATS has actually put the report up there. So if you're going to actually buy the security, you can click on the link and see the most current information. That is how you enable this marketplace. So it's like continual disclosure that's going on. This is not what is going on currently, which is these blind pools. You've got, the VCs and the private equity doing these exchanges amongst themselves and making deals and figuring out prices. This is like a true marketplace where if you want to list in this open sort of platform area where investors can buy and sell these securities, they need to be offered up the most recent information. And so, and that's the startup that, I got working on as well, which is Guard. We work and help these companies with that ongoing disclosure because we understand that you can't make an informed decision if a company, the last time they issued some financial statements was 5 years ago.
Yeah. Great point. It'll be exciting to see this develop further. It has hopeful and scary implications, as you point out, right, Woody? If the stock is trading down, you're not going to raise money at a higher valuation than where the stock trades. So there's that scary side, but creating liquidity for investors is a huge, huge benefit that could allow entrepreneurs to raise much more capital. So it is an exciting space to be playing. I appreciate that. I just want to highlight for the audience that if you have questions for the panel, I would invite you to please submit your questions using the Q&A button. If you just hover your mouse over my face, your mouse may melt, but then you can click on the Q&A button below it, and you'll be able to submit a question if you have a question for one of our experts. But Jenny, let's come back to you for a minute. What protections are provided to people who invest under regulation crowdfunding, and why are they important?
Yeah, I mean, the main protection really is disclosures. So it is kind of buyer beware. There are some other protections in the sense that there have to be background checks on the issuers. There's some limitations on who can make offerings, if they have a history of committing fraud. But primarily, it really is just look at the disclosures, really understand what you're investing in. And when I have a big pet peeve that some of the platforms really don't make it that easy to find the disclosure. There's a certain platform where if you try to the disclosure that's required by the federal government is called Form C, which is a bit of a misnomer because it's not really a form necessarily. It's more of just like a set of disclosures and questions that have to be answered. And this form has to be filed with the SEC, and ideally you would read the form, read the responses to the form before you would make an investment, because the whole purpose of Form C is to provide disclosures to investors. I would guess probably 98% of people who invest under regulation crowdfunding don't look at the Form C, and there's at least one platform where it's almost impossible to find it. So I think we just really need to encourage people to do their due diligence, understand what they're getting into, and also get to know the different platforms and how seriously each one does take compliance, learn which ones have been fined in the past for lack of compliance, learn which ones have listed offerings that are actually completely illegal, but listed them anyway. It is a bit of a Wild West, unfortunately, but there are really good offerings out there that you can tell the issuer really took the time to fully disclose all the information, to do, the disclosures comprehensively. And those are the ones that you should really be investing in. Don't just invest in the next bright, shiny offering that you see, I would suggest.
Thanks, Jenny.
If I could just add to that,
Please hop in.
Jenny hit the nail on the head. Just because the SEC qualifies a Reg A offering, just because an offering's on an investment crowdfunding platform, and it's checked the boxes that it's completed the disclosures, in no way makes that a safe investment. that they're just filling out the requirements that you need to do. You still have to look at the people and say, do you have the experience in terms of running and scaling this company in this industry? What's your track record been as a business? None of, just because an offering is qualified doesn't mean you don't do any of that other stuff. You still have to do all this stuff. There's, it's the risk is there. That's the whole point of this whole startup space is, half of all businesses, startups will go out of business in, the first 3 years. Take that into consideration. Then you have to figure out, have they been past that? Do they have experience at raising money? Can they scale this? And those are the things that you need to take into account when you're making your investment decision.
That's
Yeah,
a
and
great.
really you should know what it is you're actually investing in. I think a lot of people don't really look at that. So for example, I recently invested in this bakery in Oakland called Firebrand Artisan Breads. And if you really look at what you're actually investing in, sometimes on some of the platforms, you're investing in some kind of a holding company that is set up by the crowdfunding platform. You're not actually even investing directly in the company. And so you really need to look at those legal documents. What are you actually getting when you're investing? Is it stock in the company? Is it an ownership interest in some weird special purpose via series LLC thing that you don't even really know what that means? What is that even legal in most states? So look at what you're getting when you invest.
Yeah, good point. Nick, there are a lot of reasons why people are inclined to accept cryptocurrencies as payment for a variety of things, whether it's a nonprofit accepting donations, which is really tempting when there are, people who have created tremendous wealth recently through crypto, but all kinds of stores. Overstock.com is one that's very famously made a big point of accepting crypto. What's your take on the risks associated with accepting cryptocurrencies?
There's two big risks in the space for accepting cryptocurrencies, actually three. The first is you accept dirty money, and the anti-money laundering controls in the cryptocurrency space are pretty bad. So the outsourced company that everybody uses, Chainalysis, is, to my mind, selling deliberately defective product because they'll say things are clean when it's clearly dirty. But there's two other big risks. The first is cryptocurrency is actually a turnoff. So a few years back, Mozilla did accept cryptocurrency, and they did an A/B test. So half the users would be presented the version that included you could also pay with Bitcoin, half of them did not. And it turned out adding the cryptocurrency option reduced donations by over 8%. So it turned out to be a money loser. And this wasn't a one-off. There was this company called Holy Hemp that the guy behind it was actually big into Bitcoin, and he A/B tested and saw the same results. And partially it's because they aren't good for payments either, that if you believe in cryptocurrency, you don't actually want to spend it because it's basically designed to be deflationary. And if you don't believe in cryptocurrency, why are you going through all these motions to deal with it? But finally, the problem is the cryptocurrency advocates can often be, well, outspoken fanatics. So when a company will do a splash, say, we're going to accept cryptocurrency through some Baroque thing that's really hard to deal with, they'll get a little publicity for it, but they won't see an increase in sales. But then you quietly drop it, like Microsoft quietly dropped some cryptocurrency options a while ago. And the online community of the cryptocurrency folks, even though they were not actually using the cryptocurrency to buy stuff, go and create a big mess. So there's a risk in accepting cryptocurrency of it driving people away. There's a risk of accepting and then no longer accepting cryptocurrency of getting the irate cryptocurrency backers mad at you.
great collection of risks to be aware of. We got a great question from the audience. So this is an anonymous attendee submitted the question that I think is triggered likely by the FTX meltdown, right? And because I think people have been asking this question, and it's a great one. And maybe Jenny, you could start, but it'd be interesting to get all three of you to just take a minute on this quickly. But why doesn't a VC firm like Andreessen Horowitz have any responsibility for making investment advice when they push their crypto portfolio companies so publicly? What do you think, Jenny?
Yeah, I mean, they don't. So VCs are not regulated as investment advisors. You know, they're investing money. They're not advising people on how to invest their money. So they're not regulated in the same way as someone who's out there giving investment advice. You know, they can do whatever they want with their money pretty much. And of course, if people hear that they're doing something with their money and they say, ooh, I'm going to follow on with what they're doing, that's not Horowitz's fault, right? So yeah, it's unfortunately what VCs invest in is very crazy sometimes when you look at the crazy things they do, but they're not responsible to anyone other than their limited partners. They're not responsible to the public for the decisions they make, which, you know, we could argue that's not a good thing because they have such a big impact on our economy when they, you know, when they pump things up that blow up because they made such a stupid decision, it has an effect on the whole economy. But under the current rules, they're not responsible for that.
Interesting. Woody, do you want to jump in on that topic?
I mean, I have so many mixed reviews on this. You know, VCs, you know, private equity, hedge funds, they all play a very important and specific role. And I think it's important to acknowledge that they do things right as well. They're not all bad. You know, we owe so much to the fact that they took big risks because they write big checks to get a lot of this done. And you know what? You know, I imagine when they're investing in some of these crypto securities, crypto companies, that they're thinking the technology behind it is going to change the way we do and operate our lives. And, you know, I would hope that that is, you know, driving a lot of their decisions. You know, ulterior motives, I'm sure, get in the way. They need to, you know, they have to report to their investors. They have to show traction. They're not going to raise another fund if they haven't, you know, exceeded expectations on their current one. So the motives are very mixed as to, you know, what's going on. And you know, just like you've got bad actors, FTX, you know, even within these VCs, I'm sure there's, you know, a partner or something that is the one that takes the risks. And maybe that's, you know, that's just their job. You know, you don't want them doing it with billions of dollars and having investors lose, you know, a ton of money. But, you know, as Jenny was saying, they're not regulated entities. They can really do whatever they want. So if investors are willing to take that risk, I'm sure they understand that it comes with, you know, the potential of losing quite a bit, which we've seen happen over and over. So the moral of the story is we've seen this happen over and over and over. Ask the questions when you're going to invest in these VC funds, see what the risk tolerance is for, you know, investing in crypto, and, you know, make sure you're going in with your eyes wide open. You're prepared to lose as much as you put in.
Yeah, good point. Now, Nick, you may want to address this question that Brian Christie submitted to you, and maybe it ties in with this broader conversation we've been having about the responsibility of venture capitalists who are backing crypto companies. But do you have a view on the underlying blockchain technology underlying and behind cryptocurrencies? Is that technology novel, sustainable, valuable to society?
There is one valuable thing that blockchain does. When anybody says you can solve X with blockchain, they have literally no clue about how to solve X and you can ignore it. Because at heart, a blockchain is just a append-only data structure. So imagine a world where you have a Google form that you can put in data. When you put in data, and click submit. There's checks done then, and that's it. And then it gets added to a giant Google spreadsheet that stuff gets added onto. That's all a blockchain buys you. It doesn't actually address the hard problems in the data space. So I created my iron law in response to seeing a presentation where, among other things, the legit, this was at a Berkeley class, legit guest speaker goes, okay, in India, you have supply chain issues on vaccines. If temperature gets too hot, the vaccine is ruined. And this was back in 2019, so people didn't know about cold chains then. And you can solve this with blockchain. And my response was a literal facepalm, because you solve this with $1.50 shock watch labels. You get this little label, you stick it on, you pull a tab, and it changes color if it ever gets out of temperature spec. That's how you solve the cold chain issue. It's the monitoring. How do you know whether it got out of spec, not this mythical record keeping? And so blockchain is basically a buzzword, but under the hood, it's garbage. So how many have heard of Ethereum and Web3 as this great revolution? Okay. The entire compute power of the Ethereum world computer is 1/5000th the compute power of this Raspberry Pi sitting on my desk. A computer that is so cheap, this costs $50 when they're available, and I'm just using it to program something. That's all. The underlying technology, when you actually look at it from a technical standpoint, is garbage, but it's garbage for a very good reason. And the reason is they want to avoid the regulations on money transmission. That I could build a system that could do everything Bitcoin and Ethereum does, that would run on 10 computers scattered around the world, 6 of which need to be trustworthy, and the computers are $50 computers, and the energy consumption is a big light bulb. Why doesn't that happen in the cryptocurrency space? Well, if I was doing that with identified entities, it would be clear that I was a money transmitter because I'm transmitting and recording value. And one of the things the cryptocurrency folks really don't want to be is regulated as money transmitters, because there's a lot of paperwork that they have to deal with like know your customer and everything else. And so the underlying technology is hot garbage in order to create a illusion that there's no responsible money transmitters in the system. In reality, there actually are. They just like to pretend that they aren't.
Interesting. This is a fascinating discussion. What do I want to come back to you with? Well, Jenny, let me ask you first a related question. When does crowdfunding work best for entrepreneurs? You've raised money, you have an interest in or ownership interest in crowdfund Main Street, so you're close to this. When does it make sense for entrepreneurs?
It can make sense at a lot of different companies at different stages, different types. As long as you have if you're early stage, if you have a clear business plan, you know what makes sense to offer to investors, and you understand what it's going to mean to have investors on board for a long period of time, and you know how to do your due diligence on the platform. And I had one client that had set up a corporation. They were offering convertible notes, and they were taxed as an S corporation. And they went to raise money on one of these platforms, and that platform told them, you cannot raise on our platform unless you're a C corporation. So all of a sudden, because of their model of how they use this special purpose vehicle, all of a sudden they were telling this issuer, you can't be taxed the way you have chosen to be taxed. I mean, that is insane, So, I mean, how you're taxed is a very important decision. Your crowdfunding platform should not be the tail wagging the dog of how you choose to be taxed. So, you need to be pretty sophisticated and don't trust the platform to tell you the right way to do it. You need to have your own advocate on your side that understands. And by the way, there are big offerings. There was a $5 million offering completed that was 100% illegal on one of the platforms. And nobody said, hey, that you're not allowed to offer this. This is a fund. You cannot offer a fund on under regulation crowdfunding. So if you do want to use crowdfunding, it's a great tool, but you need a good lawyer, a good advocate on your side who can stand up to the platform when they're wrong. There are many lawyers I know that won't even deal with certain platforms because they're so disrespectful of the regulations. So, it's a great tool, but be careful, because if you break the law because of bad advice or crazy, disregard of the legal rules by the platform, that you're not going to necessarily be innocent just because you say, oh, well, the platform told me this was okay. It can blow up your company. So that's what you just really want to have in place, before you start thinking about doing crowdfunding, a really good understanding of the rules, and just someone on your side to make sure you're doing it right. And of course, you want to have good financials because you do have to prepare, professional financials.
Yeah. Now, Woody, I want to just flip the question for you. When does it make sense for ordinary investors to invest in Reg CF offerings?
That's a good question. So I've seen the profile of the issuers change since the industry launched. When the industry first launched, we had predominantly startups, younger than 3 years old, many pre-revenue, out raising capital, and it fit the bill of what the VCs were saying is these are too risky for us. They haven't proven themselves. We're not going to invest in it. So it takes a certain person with a certain appetite to believe in that individual and that company to make that investment. That profile has shifted dramatically. This past year, 68% of the companies raising money were post-revenue. Their average revenues were over $1 million. They were more than 3 years old. I think it was 3.4 years on average. So the profile of the company is completely different. I think from an investor's perspective, first and foremost, and Jenny pointed this out, you have to understand what the business is, what the industry is that they operate in, and if you think that they've actually solved the problem that people will pay for. Like, that's the lens under it. Like, is someone going to buy this? If so, do they have the ability to grow this? And is someone going to acquire it so that I get my money back? I think that's the lens under which investors should be making this decision. If you're just going to be investing in your friend who has a startup with a great idea that's pre-revenue, I would say go in on the low. If you just want to back them because you love them, go in, there's the minimums are minimum, they're small. Go in with a little amount. I think the beauty about this is you've got bandwidth based on how much you believe in it to invest up to a certain amount if you're, a retail investor. But, you just have to go in with your eyes wide open. I see a lot, it's funny, the logic in the system is there. The investors are investing in the companies that are more established, that have more revenue. They're pouring more money into it. There's more investors in it. I love it, because I kept on, when we kept on telling Washington, I was just like, the crowd can be smart. You got to trust that they can do it. And now we got the data that says it's actually working. But, you don't defy logic just because, you have a new mechanism for raising capital. You have to understand that you sort of need to act like a mini VC. How do VCs make their investment decision? You sort of need to put on those glasses and look at it from that same point of view. If it doesn't meet that investment criteria, that a VC would invest in. It doesn't mean that you wouldn't invest in them. I would just go in with a smaller amount and understand that you could probably lose it all.
Sometimes you do that for a friend, right?
Yeah, totally.
Yeah, well, Woody, thank you for that. Nick, I want to give you the last word here tonight. Would you just take a minute and think about the advice you would give an ordinary human being who's interested in investing in crypto? What would you tell them right now?
That the cryptocurrency space as a investment is a lemons market, and a very sour lemons market at that. There's a lot, basically 99.9%, if not 100%, is skirting the investment rules that we've been talking about that are designed to protect you. And in fact, most cryptocurrencies basically have no revenue model at all. There's no dividends, there's no interest payments, etc. If I have a market where there is no outside money coming in, but just that of other participants, it means the only way I can make money is at somebody else's expense. And there's really two ways of thinking about that economically. First of all, parimutuel gambling, where you're not investing, you're just betting whether number goes up or down, or a Ponzi scheme. And the cryptocurrency space did not set out to create a Ponzi scheme, but it has become effectively a self-assembled Ponzi scheme full of basically all the bad scams from the past 500 years of finance, just repeated because the regulations are annoying. The regulations are burdensome. But those regulations, safety regulations, are written in blood. Financial regulations are written in red ink. And these basically, the cryptocurrency space for investment is not an investment. It's gambling, it's a Ponzi scheme. And frankly, if you want to go gamble, go to Vegas. There's better restaurants.
That's a great way to end that. Well, listen, I want to thank all of you, Jenny, Woody, Nick. Thanks for taking the time to be with us today. I want to thank everyone who attended. I know I have learned a lot, and I'm grateful for the opportunity to hang out with these people and learn from them. I'm grateful that you would all attend and take the time to ask great questions. So we hope those of you who haven't already will consider joining the CfPA. Visit cfpa.org to join. We would love to have you as members and appreciate your help in growing this thriving industry to better serve our country and help us build, the jobs that Woody was talking about at the top of the hour. So thanks, everybody. Take care, and we'll see you next time.